Hi everyone. Thank you so much for coming today. For those of you who've been at talks at the Centre for the Study of Existential Risk before, you know that we're interested in the biggest risks that humanity faces in the 21st century, and a lot of our talks tend to be on scientific analysis of these risks, trying to figure out which ones we need to take seriously and which ones we can safely reject as science fiction. However, with some risks, they are so very clearly present and so very clearly things that we need to worry about that all the scientific analysis in the world won't get us any further. We need to start thinking about how we can actually affect change on these. And often that means, how can we change our behaviour? How can we change the behaviours of the companies and the governments who will play the biggest role? Climate change is a perfect example of that. There's still plenty of good work to be done in climate risk, but if we hope to do anything about climate change, we need to change behaviours across various sectors, the automobile industry, the fossil fuel industry. We need to develop the technologies that no longer rely so heavily on fossil fuels. We need to change many, many things about the way our world works. We've been lucky enough today to host, with our collaborators at Positive+Investment and Cambridge's Global Shapers, a workshop on the role that investment and shareholder strategies can play in shaping the attitudes of companies towards these challenges and towards heavier investment in renewable energy technologies. And as part of that, we've been very lucky to have, as one of the participants and speakers, Colin Melville, who is one of the most important people in this space. He is head of global stewardship at Hermes Investment Management, is also founder and chair of Hermes EOS, an innovative, successful stewardship and advisory service for large institutional investors. He's chairman of the Social Stock Exchange, a board director and chair of the Finance Audit and Risk Committee for the UN Principles for Responsible Investment, and a business mentor at the Prince's Trust. And for the last 2 decades, he's been at the forefront of socially conscious corporate investment and responsible development. So without further introduction, I'd like to hand over to Colin.
Thanks very much, Sean. Thank you, Sean, for that kind introduction. I'll cover a fair bit of ground with you, and I'm going to get you to do some work as well, because I have some questions for you, but we'll get onto that later. One thing I think I'd like to say, I've never come across such a wonderfully named centre in any academic institution. The Centre for the Study of Existential Risk is fantastic. I think the financial services industry itself represents an existential risk. Genuinely I do, and I think many other risks flow from it in its operations. And I hope to convince you of that this evening, and to convince you of how you are connected to that, and therefore how you have an opportunity to influence it. Because all of you here are shareholders. You may not think you are. Some of you probably know you are, but you all are. I hope you are. You're saving for pensions. You've got some sorts of savings or investments. And those savings are invested in companies. And those companies are doing things you don't like, or you wouldn't like if you knew about it. So it's kind of been done in your name. And I guess that's the first point, that the capital which goes into the capitalist system is ours. It's our capital. It's invested in companies, but it's intermediated. There are people between us as shareholders and the companies that we invest in. And those people are self-interested, basically in one thing, in transactions. They're not particularly interested in you, and they're not particularly interested in the companies they invest in, but they are interested in buying and selling things, because that's what they get paid for. And that, as I hope to demonstrate to you, is a tragedy, and one which is at the heart of many of the problems we face in our society, environment, and economy. But before we get into that, a little bit of background and a little bit of a structure for the evening. So what we're going to do this evening is consider the roles and responsibilities of shareholders, you and me and others, and in the context of the discussion we had earlier today, some of us, so how we can do something about climate change and other existential risks. So I'm going to look at the question, who actually controls companies? I see companies as the engines of wealth creation in our economy and society, but who controls them and in whose interests are they run? I'm going to argue that the financial system is dysfunctional as currently structured, and I'll propose some practical remedies for that which you can get involved in. And in doing that, I'm going to describe an emerging obligation and opportunity for pension funds, such as the ones that you may well be investing through, endowments and other institutional investors. And you'd recognize here a link to Cambridge, because of course Cambridge has endowments and pension funds and investments. And those investments are also invested in companies that are doing things that you wouldn't like. And maybe you can do something about that with your influence. And so there's an emerging obligation and opportunity for these endowments and pension plans and investors with regard to business and the public good. And I'll characterize that as a shift in focus from short-term transactions, the simple buying and selling of things, to longer-term relationships, and that relational behavior being what we want to encourage. And I'll propose that such investors, so you and people on your behalf, have a self-interested duty to engage with multinational corporations to promote their international standards on human rights, environmental management, and other issues material to the corporation's success. And I'll argue that the interests of the corporation and its shareholders and other stakeholders converge in the longer term. And I'll present some practical measures for promoting that convergence. So the idea there is that if companies behave well, they make better investments. Now, for all of you here, that might be kind of obvious, simply straightforward. Yeah, surely that's right. If a company behaves well, it does well. There's a stronger social license to operate, maybe lighter touch regulation, more loyal consumers. But that's not how fund managers think. They don't see the world that way. I started my life in investment at Standard Life Investments in Edinburgh 22 years ago. And 22 years ago, I arrived there as a historian. So I have 2 degrees in history, one of them from Cambridge. I did my first degree in Aberdeen. I did a master's at Cambridge in history and philosophy of science, which makes me a pretty strange person then to be talking to you about investment. And I arrived at Standard Life Investments not wanting an investment career at all, but wanting to look after my young family and needing to earn some money. And that paid me more handing out the mail and doing the filing on maternity cover, which was my job. That paid me more than working in a library or working in a museum. And so I took the job. And I found myself sitting amongst people who were very clever, doing something very simple. And I couldn't believe it. It was like a waste of intelligence. They were taking this narrow set of historic financial information and trying to predict what was going to happen in the next quarter or 2 quarters. But they were investing in real things, in businesses that employed people, that produced goods and services. And they were ignoring that unless it impacted the short-term financials. And this just amazed me. And I'm still there trying to do something about it. Because I just saw this complete disconnect between what should be the beating heart of capitalism, the fund management industry, which should allocate capital efficiently and effectively into the economy, and what these people were doing. Not that they were bad people, it's just the culture. And it hasn't changed. 22 years on, I'm still encountering this sort of behavior. And why is that? And what can we do about it? Well, the reason it happens, I think, is not through malice or malintent or ill intent. It is because that's how we are paid as investors. We're paid fundamentally to buy and sell things. And our industry has adopted a set of behaviors which lead ultimately to dark pools and high frequency trading, which you've probably heard about and probably don't like. It doesn't sound good, does it? And it's not good. It's a kind of market abuse, really. But there's no social utility to that activity. It might be described to you as useful for price discovery in a kind of fine way. We really know what the prices are of things, but that's not true. It's just a way to make a turn, increasingly desperately, by getting an informational advantage of some kind ahead of someone else. And the securities that are being traded around are the securities of companies. So we need to do something about that. And the reason we need to do something about it is not just because you're paying for these transactions, which you are, because it comes out of your return as investors, but because that sits in the way. If you're the chief executive or chairman of a large company, or even a medium-sized or a small company, even worse, in the UK, your experience of talking to your shareholders, the owners of your business, if you're a listed company, is dismal. You're talking to people who are interested in transacting information. And why is that a problem? Well, that's a problem because you're going to need some guidance from your owner. If you were here, the owner of a single property, and there were people managing it for you, would you be interested in what they were doing? Well, of course you would. You'd engage with them. You'd make sure they were maintaining the property. They were looking after perhaps the environmental issues now around that. But that's not happening. And that's what needs to change. And so the problem is twofold. One, the transactions and excess transactions cost something, and that funds the city, and that's why it's wealthy. And the second thing is there's an absent ownership. There are major corporations, the engines of wealth creation in our society and economy are operating as if they have no owners because of that intermediation by people who are self-interested in transactions. So I'm aware in my industry there's quite a lot of jargon. I hope I've explained it clearly. But are there any questions so far, or indeed would anyone like to challenge this dystopian vision I've created for you? Yeah.
What would an investment manager say if he heard you saying what you're saying right now? I mean, what would be his standard response, or she?
The investment manager, would complain, but potentially. Not all of them are like this, I should say. I'm characterizing the industry as a whole, and there are pockets of investment management which are quite good. I'll introduce a technical term now, which is liquidity, which some of you will recognize as the ease of buying and selling things. So if an investor is invested in an illiquid situation where it's difficult to sell or to buy, then they tend to be more interested in the quality of the asset longer term because they can't sell it so easily. And so you'll find that fund managers investing in smaller companies or emerging markets, maybe private equity, tend to be more interested in engaging and the ownership and the quality of ownership. But that's not where most of your money is invested. It's invested in large liquid markets, in large companies where you can sell very easily. And so the fund manager isn't going to worry too much about that. Or even worse, it's invested in passive situations. Passive investment is where you buy the whole market, a little bit of every company, and then just wait. It's very cheap. You can do that just with a computer. Well, you can't. Well, you could probably, given you're all very clever people. But the investment managers do this in a kind of commoditized way. It's a very cheap way of managing money, and a lot of people have moved to passive investment recently because you get exposure to markets, whole markets that way. But that's even worse because there's no resource. You've got a fund manager investing in thousands of companies, maybe 10,000, and a team of 5 people doing the engagement with companies on longer term issues like climate change and bribery and corruption and child labor and overpayment of chief executives for not performing, and all the things you'd want to be interested in as an owner are just ignored. So what would the fund manager think? They probably wouldn't like me saying these things, but I think they'd recognize them. And some of the leaders of fund management firms are now starting to talk about this. There's a group called Focusing Capital on the Long Term, which includes some very large fund management companies that has a set of principles and a couple of papers which are setting out a different vision for the industry. The Principles for Responsible Investment Initiative, where I'm on the board, a set of 6 principles which addresses these issues. The first 2 principles, if you haven't come across this, unpri.org, org is the place to go. First 2 principles are, we will incorporate a broader set of information into our investment decision making, which is known as ESG integration, environmental social governance integration, and we'll be good owners of the assets that we invest in. So 1,500 companies, fund managers, pension funds have signed up to these, $60 trillion backing them. There's a will to change. We know we need to change, but we're not changing. Not really. And why is that? I've spent most of my career in investment, those 22 years, looking at the relationship between the fund manager or investor and the company invested in. And it occurred to me recently when I was given an opportunity to free up some time and not manage the team anymore, that what I was really doing there was looking at a kind of interdependence. There was an interdependence between the investor and the entity invested in. So if you're investing in a company and the company does well, you do well as a shareholder. Obvious again to you all here, I'm sure. And so it's therefore rationally in your interest to engage the company at senior level and get them to change. And I set up a service to achieve this 11 years ago. I work at Hermes, which is owned by the British Telecom Pension Scheme. This is Hermes, not Hermes. It's often very disappointing to people when I explain that. but it's obvious. So Hermes, which is the messenger of the gods, by the way, that's why it's British Telecom Pension Scheme owns Hermes, messenger of the gods, linked to telecoms. And it's a fund management company. It's got about 250 employees, a smallish fund management firm. 11 years ago, in conversation with the trustees of the BT pension scheme, we realized that there was no business model within investment management to support this process of stewardship or engagement that I was describing to you, for the reasons I've already given. Fund managers don't do that because that's not how they're paid. And so the BTPS trustees and I realized that if we could create a service, they could pool their equity together with other pension funds, ignoring the fund managers, and they could just get on and buying and selling the shares and do what they want to do. And we could then engage with the companies on behalf of this group of pension funds. And that's what we did. So for very small beginnings 11 years ago, it took us about 6 months to get our first client, about 3 years to get 4 clients. We now have 42 pension funds, $280 billion in assets under advice, and we engage 450 companies a year on behalf of this group of 42 funds. And we're doing that regardless of what the fund managers do. We aggregate these pension funds together. And that's enabled us to hire a team of 30 people who engage around the world. There are 13 nationalities, 17 languages. I can tell you lots about how to manage diverse teams if you'd like to know that. It's very hard, but if you get it right, it's hugely creative. There's so much energy and creativity and diversity, but it requires the right culture, which I'll come back to culture in a minute. And so we engage companies on, well, climate change. That's #1 issue for our clients at the moment. We have a Danish pension fund client that has an environmental activist on the board. They campaigned and got elected to the board of this pension fund, and they're now lobbying to get the fund to divest carbon-intensive companies. That's amazing. You know, there's no way that would have happened 5 years ago, but this is starting to happen. And so it's the #1 issue for our clients. And why is it the #1 issue? Because they see this as a major existential risk, a major risk to the value of their portfolios over time. Because pension funds invest for 20, 30, 40 years or more, yet their fund managers are buying and selling in the margin, looking at the next quarter. And so our clients have hired us to engage the companies that they invest in to get them to address carbon risk and climate change, which we're doing. So much of our discussion today was on the auto sector. And my team, working with others, produced a set of questions that we ask of companies in the automotive sector, which you might be interested in. I can leave a copy of this for you later on. But they cover governance, the implementation of strategy, emissions management, public policy, transparency and disclosure. And in each area we're looking for the companies to respond to us. We're calling them to account for the quality of their leadership at a very senior level and to get change at those companies. And all of this change focused on long-term value. We're not activists in the normal sense in any way. We're not looking to make the world a better place for the sake of it. We'd like that. I would personally. And I think actually that converges with a financial agenda in the longer run. But our positioning and engaging with companies is very clearly to make them better because our clients will do better as investors. Remember, it's kind of the same thing. Doing good and generating value in the longer run, I think they converge. And so in engaging the world's major oil companies on their preparedness for regulatory change, they're preparing business models for different warming scenarios, on their disclosure, and indeed in the early days on their acceptance of climate science. We were doing this all from a kind of hard-nosed mainstream financial perspective. That's a key part of our messaging. And we're working with companies to get change. We're not lobbying them in a kind of adversarial way. We recognize that we're in it together, to use a tired old phrase, but one that actually says something in my job, that if we work constructively with a company, we're much more likely to get a lasting change. And that's our positioning. So it's very unusual for us to take an aggressive stance against a company. You won't see Hermes in the media very often. I think of the 450 engagements we did last year, maybe 11 of those were public, and that's usually because the company itself has gone public, not that we've done that. That was a very long answer to your question. There was one there somewhere. Any other questions for clarification at this stage? I promised to ask you some questions, which is probably about time I did, I think. So question one is, to what extent do institutional shareholders, so so you, through your pension funds, control public companies. Do you believe me that we can control these companies? You know, I said $280 billion. Wow, that's a lot of money. But what's that in actual share terms? I mean, what proportion of the equity do we actually own or hold? If I tell you it's less than 1%, do you think we can really control companies? Do you? What do you think? Do you think it's possible? Yes?
Yes, if we could get a bit of a role on it. I mean, we need publicity, and people on board, and so on.
Yeah, yeah. So it's something about the quality of the relationship, which is important.
Yes.
I think. Yeah. Yeah, that's true. Yeah.
I think what's often quite interesting in what I've seen is actually that, as you said, such a small number of people are actually making those decisions, so the potential for leverage is actually quite high.
Yes.
So although we don't have all that much money, there's also not that many people working to make those decisions.
Having the conversations, yes, that's
So
very
the personal aspect of
very
it.
interesting. I lobbied for quite a long time against compulsory voting of shares for that reason, that would dilute the thinking vote with the unthinking vote, which would go in favour of management. Yeah. So it is possible to do, and we do it. We do get change. Around about 80% of our engagements, we see progress year on year. We draw upon a broader network of shareholders, so we don't just represent our client group, but we'll draw in other investors. We have very good relationships with the Californian Public Employees Retirement System, CalPERS, USS here in the UK, which is the University Superannuation Scheme. Some of you might be members of that, and many others. And so they're not clients, but they work with us. Our clients tend to be large corporate pension funds, public pension funds, and similar, and they're global. Our most recent client is the Japanese PFA, which is the Pension Fund Association. It's a group of corporate pension funds in Japan, which have hired us recently to represent them outside Japan and inside Japan in relation to their investments. So we do that. So it is possible. We've got various techniques for building strong relationships with companies, and I'll come back to this word relationship shortly. So what we do is, outside the engagement program, we'll arrange dinners for the chairman of FTSE 100 companies, for example. We've done something similar in Germany, where we discuss a topic with them through an evening. We have some of our clients in, maybe a group of 12 people, and we position that we're working with them to get their advice so we can become better at engagement. That works really well. We also invite them into our client advisory council meetings. We get our clients together twice a year in the client advisory council, and we draw in directors of companies at those meetings in order to get to again build trust and get some understanding of what we're about. And so our reputation, and that reputation that we carry into these conversations, is very, very important. So it is possible. Institutional shareholders do control public companies to some extent, but it requires much greater coordinated action. And hopefully, if we can lengthen timeframes, and if what we're hearing from the leadership of some of these larger fund management companies is true, and they are going to change and transform, and we'll talk about that later, then we'll start to see more collaboration, more working together. Right now, fund managers tend to behave in a competitive way, and they don't tend to work together very constructively. And we'd like to change that also in due course. Another question. I mentioned diversity earlier. And I give you some idea of why I think diversity is a good thing. But why are shareholders interested in boardroom diversity? Is that important, do you think, in the context of what we do? To what extent should we be interested in diversity at all as institutional shareholders? Is that what you would expect? Yeah.
To avoid groupthink.
Uh-huh.
In boards.
Yeah, definitely. That's part of it. Anything else? Yes.
Studies have shown, right, that like boards that are more diverse, their companies actually perform better. So like if we're purely self-interested as investors, surely we'd want more diversity for that reason.
Yeah, I'd like to see the studies. I'm sure there are.
Yeah, I'm pretty sure. I think I just read. I think it was in Sheryl Sandberg's book Lean In, where she mentions studies about boards with more women on them.
Yeah. Yes, that is true. Yeah.
For the same reason, you diversify your assets.
Uh-huh.
Diversify
Nice.
your thinking.
So it's kind of risk management aspect to it as well. Yeah, yeah, very good. There's kind of creativity as well. I mean, often it's given as finding the right skill sets for the board, so that if you find an engineering company without an engineer on the board, you might be a bit worried, for example, as an investor, and that's true. But there's something about a broader set of skills, which I think is very important. But it does require the right sort of leadership and management. And one of the things I've found within the investment industry is that we tend to have a very simplistic command control type leadership or management, which militates against making the best of diversity. In my historian days, I would have said our industry is going through a hegemonic shift, which is kind of Ponzi historian's language, for a shift in language and understanding, what we apply to our jobs and our understanding of our place in the world. And I think that's starting to happen. So that the investors that are the leaders of some of these fund management companies have started to get anxious that they can't keep behaving the way they're behaving because they see systemic implications for that behavior of the kind that I've mentioned already. And so the shift I would characterize as a shift in focus from the transactions we discussed earlier to relationships. So from short-term transactions to long-term relationships. And that might sound like a quite a simple concept for you. Yeah, isn't that obvious? But actually that's a change in worldview or mindset. Where the industry is right now is in a kind of a supposition of scarcity. So if your skill relative to mine as a trader means that you win and I lose, then that's great. You've done well and I haven't done well. But has anything actually changed apart from that transaction between us? Well, not much. But that's the way we behave. So that, and that's within a kind of zero-sum trading game or scarcity environment. And what I think is happening is we're realizing we can't keep doing that, and that instead of looking at the company we invest in as a financial counter to be transacted around, we're starting to see them as a set of stakeholder relationships. And if we understand the quality of those relationships and the direction of travel and improvement, we understand something about the company's ability to generate real value in the economy and in relation to society and the environment. And can you see that's a very different thing? One of this is really kind of, it supposes that there's a finite sum of wealth and we're kind of competing to get a bit of it. And on the other, you've got an expanding wealth environment potentially where you're improving relationships around the firm and between the firms, across the economy, and across economies. And if you as a shareholder can get involved in that, you can then improve your position working with other shareholders. And that's a shift then in mindset or focus, short-term transactions to longer-term relationships. And I think that's what's going on. Now, not everyone articulates it this way, but for a top 20 fund management company like Legg Mason, which is one of the top 20 firms, to have investing to improve lives as their marketing tagline, investing to improve lives. That's amazing to me. I went to talk to them about this. I think they know they've got to change. They might not be changing yet, but that says something to me about their recognizing a need to transform their businesses. And I see this as a rise in empathy and interest, perhaps from a millennial generation that feels more connected. And that interconnectedness suggests a recognition of interdependence. And what I'm starting now to do and to see is that it's possible to apply the same understanding of interdependence that we see between the investor, so say the fund manager, and the company invested in, and apply that same understanding to the fund management company and the pension fund. So that we behave as an industry not just transactionally with the companies we invest in, but also transactionally with the people we invest on behalf of. And if we fix that, that will enable us to take a longer-term perspective, and that will naturally incorporate a broader set of information and enable us to do more engagement as an industry. So that's the shift in focus that I think we're seeing. And that then will lead us, and we'll be able then to take and pay more attention to the companies we invest in, to take account of climate change much more naturally as part of what we do. Because a lot of the work that's being done in responsible investment and sustainability tends to treat the symptoms rather than the causes. Which takes me to my next question for you. Have you heard of integrated reporting? Has anyone heard of that? Do you know what that means? Would anyone like to offer a definition of integrated reporting? There was some nodding. I saw over here. Yeah, there was a nod.
Yeah, sure. It's where more information about your company's performance is included in the annual reporting cycle.
Yeah.
So about some of the ESG metrics, for instance, that you
Yeah. So that sounds like a really good thing. So you take a broader set of information into a reporting on the business model, perhaps, and seeing then how that affects the company's ability to perform over the longer term. So that sounds great. Presumably we all support this. Integrated reporting sounds like a good thing. And I chair the investor network at the International Integrated Reporting Council, so I support this too. But it is, I'm afraid, an example of a symptom of an underlying problem, despite our spending quite a lot of time on that. And that is, of course, that you would say, well, why isn't this happening anyway? Why aren't we producing this? The International Integrated Reporting Council has produced this wonderful framework, and the idea that companies don't report this way because they don't know how to do it. But that's not the case. The reason companies don't already report this way is because there isn't a demand for this reporting from their principal stakeholder, the shareholder. And why isn't there that demand? Because they're stuck in this short-term dance that I described earlier. So that's a symptom. And you can apply that same analysis right across all the responsibility and sustainability work. That we tend to get involved in symptoms, not causes. And we need to look to the root cause of this, which is that relationship, I believe, between the city and its clients, between the providers of capital, you, and the intermediaries. And if we can improve that can lengthen timeframes, and a lot of this stuff will just happen naturally. We'll still need people to promote it. The other problem I see within responsibility and sustainability is that we are in grave danger, and again, I sit on the board of the Principles for Responsible Investment Initiative. We're in grave danger of institutionalizing responsibility and acting as apologists for the system, enabling it to continue to behave the way it's always behaved. If we are successful at PRI in creating an industry of responsible investment, then my colleagues at Hermes who don't get this yet will just be able to keep doing their jobs the way they've always done them. And that's not the task. The task is to change the way investment works and happens. And that's the true function then of someone involved in responsibility and sustainability investment. But a lot of people don't see it that way because they've got a job and it's interesting and worthwhile and they feel like they're doing something useful. So we need to make sure that we're actually changing things and helping to adjust the way the industry behaves. A challenging one for you, and I know there are people in the room that know the answer to this. Don't pretend you don't. What is the universal owner or universal investor hypothesis? And what are its implications for climate change? Yep.
Just that there are some investors that are now so widely invested in an economy and so diversified that they're exposed to economy-wide systemic risks. And climate change is a very obvious one of those, and that they might have an incentive to address that systemic risk. Very good.
So, everyone got that? It was a very good attempt at defining it. A lot of people struggle with universal owner, and it has broad application. You're quite right. So the idea is that a big pension fund like the British Telecom Pension Scheme that owns Hermes invests in lots of companies. Perhaps every company listed on a particular market. And if you invest in lots of companies, you've got an investment in the entire economy. If the economy does well, you do well. If the economy does badly, you do badly. And it's not just one economy, it's lots of economies. So a very big pension fund, although it might behave as if it just has investments in single companies underlying, is actually invested in entire economies. Now, what are the implications of that? Well, of course, the implication is that you have a self-interest, you have a clear interest in policy and best practice and regulation as it impacts the economy that you're investing in. Therefore, you as an investor should be fully engaged in material policy debate because you have a self-interest in that. Yet we don't behave that way, of course. You're getting the pattern here. But we should be. And so there is, within Universal Owner, a clear imperative to get involved in policy and best practice around climate change and carbon risk. It also has implications for externalized cost. One way of looking at polluting activity, including carbon pollution, is as cost externalized by the company onto the environment. Because, and as a single investor, as an investor in a single company, you'd be presumably quite happy about that. You know, you don't have to pay for the cleanup. What's the problem? As long as the regulation isn't there to stop it happening, you're fine, aren't you? Rather cynically, I'm sure you wouldn't behave that way. But if you're investing in all the other companies in the economy, then for a single company to be polluting, obviously is a problem for you because you're picking that cost up elsewhere within your portfolio. And so it suggests then also you should be concerned about environmental pollution by individual companies within your portfolio, because that will damage the environment to your detriment in the longer run. And there are, I mean, I'm sure you can think of other implications. Universal owner is an amazing idea, which is not properly understood or implemented across the industry, but I think needs to be. I'll give you another example, tobacco. So many investors, including probably everyone here who's got a pension or investment, is invested in tobacco companies. You are. And there's a big discussion at the moment within the investment industry about corporate purpose. What are companies for? You know, and impact. What's the impact of a company? So what's a tobacco company for? Well, it makes cigarettes, but surely there's something in the purpose of a tobacco company which is to do with maintaining the sales of cigarettes. And how does it do that? Well, there's something there to do with the ways in which the cigarettes are marketed and who they're marketed to. I heard some statistics the other day that 40% of 13 to 15-year-olds in Malaysia smoke. Is that an accident? No, it's not an accident. Is that being done by companies that you're investing in because they think you want them to do it? Well, yes, it is, because that's how they maintain the return. So there's something there which suggests to me that if we properly analyze the behavior of companies, and I've given you a very extreme example there, and we set alongside the financial return the societal or economic impact and properly understood that and disclosed it, much of this wouldn't look okay anymore. But we're not doing that. But I think it's coming. You know, this shift, the hegemonic shift that I mentioned earlier. At Hermes, we're developing an impact investment fund. Not impact investment in the old sense of I choose to invest in something that's doing good, therefore I expect to take a lower return as kind of badge of honor, which was impact investment. Not to say it's a bad thing, but that's how it was. We're moving from that to a more mainstream idea of impact investment, which is that we invest in companies that are doing good things and expect to do well in the longer run as investors in those companies. And then we're prepared as investors to report to our clients the impact of the companies they're investing in alongside the economic return. You know, Hermes is very close to doing that now. I think that's great. And then we're going to see a lot more of that. So an interest in impact and corporate purpose. And that's the work that I do at the Social Stock Exchange, where I'm chair, where we list companies as members of the Social Stock Exchange who are able to demonstrate a good, strong social purpose and impact. And we expect that to lead to better performance in the longer run and to attract investors in because of that disclosure. So I hope that made sense on universal owner. Stranded assets you've heard about. I'm sure you're all familiar with the concept of stranded assets, are you? You must be if you're here. Are the assets really stranded? Shall I explain stranded assets first? Should I? I should, okay. So, and if anyone's got a better explanation, then do you please shout out, because I'm here amongst some people who know this very well. Stranded assets idea or concept is that if we are to get the regulation that we need to keep the warming of the climate below, let's say, 2 degrees, then we won't be able to extract and burn the known reserves that are still under the ground of coal and oil. That makes perfect sense, doesn't it? So we know we can't have warming above a certain level, otherwise we're going to encounter disaster, and surely our politicians and regulators won't let that happen. Therefore, we can't extract the stuff and burn it. But are the assets really stranded? Is my question to you. Yes?
Not unless there's a carbon price or some such, and they really can't be extracted and sold. Not unless there's some mechanism for preventing them getting extracted.
So they're only stranded to the extent that we get the regulation that we need.
Yes.
But we have to get the regulation that we need, surely?
Well, I would say so, but it's not happening, is it?
No. No, it's not. Well, not so far. Yes?
Well, except for, I mean, horses were stranded when we went into the automotive age. So perhaps that's the way in which these assets will be stranded, and they'll still be there. Obviously, they just won't have any value because there's other things that just work better and serve our
so
purpose.
it might be happening already. Perhaps we've seen the oil price much lower as a result. Maybe that's a sign of starting stranding. Yeah.
I think to add to Alan's comment, we might be seeing that with coal as well. I mean, I just saw even today China's announced it's stopping the construction of 30 coal plants that it has been building, and it's just decided to pivot away from using coal essentially.
It's a very,
so what's happening to all the
you're a very
coal?
optimistic group here. I like this.
So yeah, maybe it's already starting to happen.
Yeah. Okay. Good. Yep.
I think I'd be a bit more pessimistic.
Presumably we didn't have a horse lobby back in the day, which denied the existence of motor cars and lobbied our lawmakers against bringing regulation.
But current automotive companies aren't tied to a kind of hay-fueled. Sorry, I'm trying to work with this. The car industry can actually adjust, somewhat unlike the fossil fuel industry, actually. So there is a place for them in a future in which we don't have them powered any longer by fossil fuels.
I'd be very surprised if there wasn't There's a lot of money in that.
There might be a forest lobby. When we moved from whale oil to mineral oil, I guess there might have been a whale oil lobby shortly. Prior to
I
that.
suggest we all look at cotton.
Cotton.
The transition
Mm.
of how cotton was impacted by globalization, et cetera, et cetera.
Yeah, I mean, yeah, we should. I'm sure it's a good example. The question came to me. I didn't think it up. Are the assets really stranded? From one of my colleagues, Bruce Duguid, who leads on some of this work for Hermes and our clients. And we were walking on a beach together in Findhorn in the northeast of Scotland. We were invited to an amazing workshop up there. And Bruce and I were walking along looking at the sunset on the way to the pub. And he said to me, Colin, the assets aren't really stranded. And I said, Bruce, what you've been telling me they are for such a long time. It's at the core of your work. What are you talking about? And he said, no, they're not. And I said, well, what do you mean? And he said, well, it's a good theory, but everyone I talk to is behaving as if it's not true. Everyone. All the company executives he's talking to, all the chairmen, all the investors, everyone's continuing to do what they do as if this doesn't make any sense or isn't going to happen. And so to all intents and purposes, it wasn't happening, yet we were all saying it was. And that occurred to me at that point that there was a real missing piece here, a piece of the puzzle I hadn't seen, which is that if the leaders of all these investing institutions are saying, effectively, they can't keep investing the way they're investing, yet the regulation isn't coming in to encourage the companies they're investing in to change, then the investors themselves have to step up and get the regulatory change. And there was a big chunk of our work which wasn't happening, which was coordinated efforts by investors properly to engage the regulator to get the regulation they need to enable them to invest the right way. And that still isn't happening. And still needs to happen. And it's going to be a big part of my work over the next few years is to encourage that sort of dialogue and interaction. You're doing very well in the questions, by the way. I'm impressed. We'll try a trickier one, perhaps. Professional. I know there's some lawyers in the room from Client Earth, quite a few of them. And to what extent would you, perhaps as legal professionals or others here, to what extent would you consider an investment banker to be a professional? It's a bit like an exam question, that one. So, yes?
It seems to me that the professional in the old style, as it were the doctor or the lawyer, is someone who understood that he or she had expert knowledge, which, in the light of which it was easy to bamboozle someone, and they undertook an ethical responsibility in exercising their knowledge that the doctor do no harm. As a lawyer, you have to respect confidentiality and interests of your client and so on. And there's a whole social ethos, a whole thing created around this. But we've got a lot of very clever people who are exactly in the same position can bamboozle us, and they have no professional ethic. I mean, the people who run our utility companies and set up the tariffs, ditto the communication devices, ditto
Thank you.
A lot of people are now in that position, and they don't.
Quite brilliant. Thank you very much. It's the best answer I've ever had to that question. I've given this talk at business schools or a similar talk around the world to MBA courses and so on. Yes, I quite agree. It's not just about doing a good job. People hear the word professional and they think, doing a good job. The investment banker, of course, would tell you he's a professional. But in conditions of asymmetrical information, which is what you've described, where you know more than your customer, client, patient, you undertake to put their interests first, ahead of your own, in return for earning more than you would otherwise for your labour. It's something like that, and that's a professional. So is the investment banker a professional? I don't think so. There are pockets of investment banking which appear anti-professional. You create asymmetries of information to maximise the return to yourself by abusing your customer. That's the opposite, isn't it? And fund management, I think we could do a better job looking after our clients. Daniel Godfrey, who was the chief executive of the Investment Association, which is the trade body for the investment industry, lost his job last year for trying to bring in a set of principles, the first of which was we put our customers' interests before our own. And he was told by his board, how can we do that? We have shareholders. Perfectly describing the problem, by the way. These fund management companies saying we can't put our customers' interests first because we have shareholders ourselves. Why isn't that the same thing? Putting your customers' interests first and looking after your shareholders. Of course it should be the same thing. But he was told that wasn't acceptable. They've now, under pressure, brought the same set of principles back in again, which I'm hoping will be of interest to some of the lawyers in due course. Yeah. So thank you very much for that answer. I really appreciate it. I think I'll probably, there's a lot more I could say on this topic, but time marches on, and I haven't really given you an opportunity to debate with me or to ask me some more free-form questions. So I'll give you one or two more remarks, and then we can go to a question and answer. I've told you who the shareholders are. That's you. Yeah, you got that now. You're the shareholders, and we will get on to what you can do about this shortly. You've heard from me that companies and shareholders, so you are interdependent, and you have the opportunity to create together a more sustainable future. So this transactional environment that we talked about is a problem. There is an interdependence between companies and shareholders, and properly understood and exercised, that leads to a better outcome. So what we need to do is shift a focus from from short-term transactions to longer-term relationships. And I characterize that as a shift in worldview or mindset, a hegemonic shift, as I described it earlier. A shift in focus from short-term transactional behavior to longer-term relational behavior, from a scarcity worldview to an abundance worldview, through which we have to work together more constructively. As is obvious to you, sustainability implies profitability. These are not separate things. So properly understood, sustainability is a profitable activity, but the generation of profits for shareholders shouldn't be confused with corporate purpose. Companies are not there to make money for shareholders. Companies need to be profitable to survive. That's like oxygen for a company, but it's not the purpose of a company. I think Milton Friedman was probably misquoted when he said the purpose of business is to make profits for shareholders. I hope he was, because that's not the case. Any company that tells me that they're there to make profits for shareholders is a major alarm bell. You know, that's terrible. If you ever see it in a mission or a vision statement, then you should be worried. That's not what a company is for. They're for providing goods and services that we need and doing it in a way that we would broadly approve of. That's the purpose of a corporation. So most of the dysfunctionality within investment arises from short-termism and the lack of professionalism, as we discussed. And for all of this, and I didn't really get onto leadership, and we could discuss this perhaps a little more, we need to encourage a servant or a synchronous form of leadership, affiliative leadership, within investing institutions and the companies they invest in. All of us, I think, can be in one of three places. I think it comes from our evolution, I've heard. We can be defensive threatened. So it's our first response to any change. Leave me alone. You know, I'm very happy, thank you. Defense threat. It's kind of reptilian. I think we were turtles way back in our evolutionary chain. The second place is resource acquiral, getting stuff for ourselves and people like us. We can all do that too. You know, we're all capable of both those things. And that's fear and greed, by the way. That characterizes the city and Wall Street. The third place is affiliative relational, mammalian, if you like. That's where we're at our best, working together to common benefit. And that's the character of leadership we require for companies to be sustainable and for investors to support sustainability by companies. And impact and purpose we talked about as well. So the impact of a company, it's very important now to understand that. And increasingly investors are interested in impact and also in the purpose of corporations. What is the company for? A very powerful question. If you're involved in shareholder engagement at all or engaging with companies, very simple but very powerful. What's the company for? What's it there to do? You ask that of a fund management company, you'll get a pretty dismal answer, I would have thought. Fund management companies are there primarily to make money for themselves and their shareholders. And individual fund managers are there to make money for themselves too. They're like little mini profit maximizing entities, all unto themselves. But that's no route to happiness or social utility. So, open to questions, and we'll get to a call to action as well by you. And the call to action, as you've heard already, is that you're all investors. You're all investing through pension funds. You're all interested in endowments. And your pensions, investments, and endowments are invested in companies that are doing things that you don't want them to do and behaving in ways that you would rather they didn't behave. And that's actually impacting the value of your funds, and it's also impacting society, the economy, and the environment, because all of that's connected. So you could write to your trustees. You could ask them to do something differently, to encourage your fund managers underlying to do some engagement, to take account of these issues in the buying and selling of securities. All of that's available to you because you are providing capital into the system. It's not happening somewhere else. It's happening in your name right now. So I'll wrap up there in terms of my remarks. I'm going to take some questions and answers shortly, but thank you very much for your attention thus far.